Welcome to Tax Shield Research Team. Today, we're examining one of the most dangerous and most misunderstood tax traps facing high-income executives, IRC Section 409, a phantom income tax bills that can exceed $200,000 in a single year. And here's what makes this particularly urgent. The IRS has significantly ramped up enforcement on deferred compensation plans over the past 5 years, making this not just a theoretical risk, but a real and present danger to your financial security. Let's start with the fundamentals. IRC Section 409A is a piece of tax code that was introduced in 2004 specifically to govern deferred compensation plans. On the surface, it seems straightforward. It ensures that compensation deferred under a non-qualified plan is taxed at the time it's earned, not when it's paid out. But here's the problem. The rules are extraordinarily complex, filled with exceptions and technical requirements that even experienced CPAs and tax attorneys frequently get wrong. When a plan fails to comply with 409A requirements, the consequences are severe. The deferred compensation becomes immediately taxable, meaning you owe income tax on money you haven't actually received yet. In addition to the regular income tax, the IRS imposes a 20% penalty on top of your regular tax rate. And if there's any delay in payment, you'll also owe interest, which compounds annually. Let me walk you through a concrete example. Imagine you're a VP of sales at a mid-sized software company earning a base salary of $250,000. Your company establishes a deferred compensation plan offering to pay you an additional $150,000 bonus over a 5-year vesting period. But here's where the trap gets sprung. The plan document doesn't include specific language about what happens if you're terminated without cause. That's a violation of 409A Section 409AA2(b)(I), which requires specific payment trigger language. Fast forward 3 years. The company is acquired. Your deferred compensation plan hasn't been amended to comply with 409A requirements. Suddenly, that $150,000 in deferred compensation becomes immediately taxable. You owe roughly $52,500 in federal income tax, 35% combined federal plus state, plus $30,000 in penalties, 20% of the deferred amount, plus interest. That's $82,500 plus tax bill on money you never actually received. And for executives with higher deferred amounts, which is common in equity compensation or retention plans, these bills easily exceed $200,000. But this isn't just a hypothetical scenario. The IRS has been actively pursuing 409A violations. According to data from the Treasury Inspector General for Tax Administration, TIGTA, the IRS opened over 300 409A-related examination cases between 2015 and 2020. That's a 340% increase compared to the previous 5-year period. The average penalty assessment in these cases was approximately $87,000 per taxpayer. Let's examine a specific case study that illustrates how quickly this can spiral. In 2019, a Fortune 500 company established a retention bonus plan for its executive team. The plan was designed to defer bonuses over a 3-year period, but failed to include proper 6-month delay language required for specified employees under 409A Section 409AA2(b)(I). When the plan was audited by the IRS in 2021, the company was found non-compliant, while the company itself faced penalties. The executives were personally liable for the phantom income tax on approximately $45 million in deferred compensation across 47 executives. Individual executive bills ranged from $180,000 to $580,000 per person, depending on their deferred amount and tax bracket. Now you might be thinking, surely my company's HR department or outside counsel reviewed this. Unfortunately, that's where many executives fall into a false sense of security. Studies from the American Bar Association and the ICPA indicate that approximately 40–50% of non-qualified deferred compensation plans contain at least one material 409A violation. Some of the most common mistakes include: first, inadequate plan documentation. Many companies use generic plan templates that don't properly address their specific circumstances. When a plan is later amended or when payment terms change, these generic documents often fail to include the specific 409A compliant language needed. Second, incorrect payment timing elections. 409A requires that distribution elections be made at least 12 months before the payment date for most distributions. Many executives aren't aware that casually discussing retirement timing with HR doesn't constitute a proper election. Without the correct written election filed within the regulatory window, the distribution could become non-compliant. Third, problematic plan amendments. When companies make changes to their deferred compensation plans, which is common during M&A activity or when changing benefits providers, they often fail to include substitution language that would allow plan amendments without triggering 409A violations. The result, an unintended distribution that becomes immediately taxable. Fourth, definition of specified employee errors. Under 409A regulations, certain key employees must wait 6 months before receiving distributions following a separation from service. Many plans either don't properly identify who qualifies as a specified employee or fail to apply the 6-month waiting period correctly. So how do you protect yourself? Here are the critical steps every executive should take immediately. First, request a formal 409A compliance review of your deferred compensation plan. This should be conducted by a tax professional who specializes in 409A compliance, not just a general tax CPA. A specialized review will examine the plan document, administrative procedures, and payment elections to identify potential vulnerabilities. The cost of this review typically ranges from $2,000 to $5,000, but can save you hundreds of thousands in taxes and penalties. Second, verify that all your payment elections are documented correctly. If you've ever discussed with HR when you'd like to receive deferred compensation, verify that there's a formal written election on file that complies with 409A requirements. If there isn't, work with a tax professional to file a retroactive corrective election if the regulatory window hasn't closed. Third, if your plan is non-compliant, you may have correction options. The IRS offers a voluntary correction program, VCP, that allows plan sponsors to correct failures in exchange for a compliance fee. For individual executives, this is often a much better outcome than facing an audit. The VCP fee is typically only 10% of the correction amount, which is vastly preferable to the 20% penalty plus taxes that would result from an IRS audit. It's also important to understand that 409A compliance isn't just an HR issue, it's a personal finance issue. The IRS holds the executive personally liable for the phantom income tax, even if the plan was established and maintained by the company. This means you need to take active ownership of understanding your deferred compensation arrangements. Another critical consideration involves equity compensation. Many executives aren't aware that stock options, restricted stock units, RSU, and other equity awards can trigger 409A violations if they're not structured correctly. Common violations include options granted with an exercise price below fair market value, RSUs with impermissible vesting conditions, or equity awards with non-compliant payment timing. These violations are particularly serious because the deferred amount can be substantial. Executives holding significant equity awards could face phantom income bills exceeding $500,000. The broader context makes this even more urgent. With increased IRS funding in recent years and a renewed focus on high-income earner compliance, the risk of audit has increased substantially. Additionally, changes in executive compensation practices, particularly the increase in deferred compensation arrangements following the $1 million executive compensation limitation, have made 409A more relevant and more complex than ever. In summary, IRC Section 409A compliance failures represent one of the most significant hidden tax risks facing executives today. A single mistake can result in a 6-figure phantom income tax bill due immediately, regardless of whether you've actually received the deferred compensation. The IRS is actively pursuing these cases, and the complexity of the rules means that violations are common even in well-managed companies. The time to act is now. Get a specialized 409A compliance review. Ensure your payment elections are properly documented, and work with qualified tax professionals to address any vulnerabilities. The cost of prevention is dramatically lower than the cost of correction and far better than the cost of an IRS audit. Thank you for watching.